There are some financial experts right now telling you that buying a home is a bad investment and you should keep renting and put your money in the stock market instead. The way they put it, that actually sounds like it could be good advice. But the problem is, if you're one of the millions of people for whom buying a home is actually a good idea, well, it might be the biggest financial mistake of your life. In the next few minutes, I'm going to show you what's wrong with their argument, what they're leaving out of their math, and what it could actually mean for you and your family in just a few short years. Stick around to the end of the video because the number I'm going to share with you later is going to blow your mind. It's an eye-popping number that is just impossible to ignore. My name is Stan Brusoski. I've been a mortgage professional for nearly 30 years, and over that time I've been involved in thousands of transactions covering just about every lending scenario you could imagine. I put this channel together to help buyers, especially first-time buyers, to understand if buying a home is a good idea and to successfully navigate through the home buying process. Please consider liking and subscribing if you find this information to be useful. Okay, so here's what's going on. A number of prominent financial commentators have come out recently with the advice that buying a home is a bad idea and that most people would be better off just investing their money in the stock market and renting instead. There's a couple of problems with that argument. First of all, the one thing that they almost always start off with is the idea that you need a 20% down payment in order to buy a home. And they say that that money would be better off used somewhere else. Okay, so for example, if you wanted to buy a $300,000 home, you'd need to save $60,000 for a down payment. And for a lot of people, that's a lot of money to save up. And so the argument is, don't take those savings once you have them and just put them into a home that isn't liquid. You can take that money, put it into the stock market, and you can earn returns on that. Okay. In fairness, there is a case to be made that your 60 grand can do a lot of good in the market. I would still argue, though, that it makes sense to buy even if you had to put that much money down. Okay. More on that in a minute. Here's the point. A lot of first-time buyers end up just putting 3 or 5% down on the purchase of their home instead of 20%. And, of course, there are some loan programs that don't require any down payment at all. And these aren't special secret loan products that nobody gets to use. These are pretty mainstream loan programs that are designed for a lot of really pretty typical buyers. So if you have a 3 or 5% down payment, well, the expert's argument kind of goes out the window. They would say that you have a massive opportunity cost putting 60 grand into a home when it could be earning returns in the market. But the opportunity cost of having just a few $1,000s tied up in a home isn't the same as when you're talking about tens of thousands of dollars or more. All right, which brings me to my second point, which is when you use a smaller down payment, it means you're buying a home with leverage. And leverage is one of the most powerful things known to man. Okay, leverage is when you use a small amount of money to buy or control a much larger asset. And what makes that so powerful is that if the asset goes up in value, you profit from all of the increase, even though you may only have a small amount of money invested. And I'll give you an example. When you put 3% down on a $300,000 home, you're not buying 3% of that house. For $9,000, you own the whole thing, the whole house. You get all the appreciation, all the equity from your monthly mortgage payments. Yes, the bank financed the rest of it, of course, and yes, you're paying them interest for that, but the asset's yours. And it's a $300,000 asset, not a $9,000 asset. So let's say the home appreciates just 4% per year in value, which is a pretty conservative number, but let's just go with that. 4% of $300,000 is $12,000. In your first year of owning the home, it went up in value by $12,000. You invested $9,000. That's a 133% return on the money you put into it. Now, compare that to putting that money into the stock market. The S&P 500 has a long-term average annual return of around 10%. On $9,000, that means you should make around $900 your first year. The home gives you $12,000. The stock market gives you $900. Are you getting this? Do you see how powerful this is? It's not because real estate is fundamentally a better investment than stocks in general. It's because of what that $9,000 is controlling. In the stock market, $9,000 gets you $9,000 worth of stock. In real estate, $9,000 gets you a $300,000 asset in our example. Okay, so that's leverage. Can you buy stocks with leverage? Sometimes. But I would argue that it is way easier and safer to buy a home with leverage than to buy stocks with leverage. For one thing, stocks go up and down in value unpredictably all the time. And, just as leverage is a really powerful tool when it's leveraged against an asset that's going up in value, it's an equally devastating weapon when that asset goes down in value. Too many investors learn the hard way that leveraging a stock going in the wrong direction, it's a great way to wipe out an entire portfolio. And besides, none of these experts are recommending that you buy stocks using leverage anyway. Okay, so now what if you actually do put $60,000 down on that house? Well, the house still goes up $12,000 in value. Your stocks, well, $60,000, 10% return, that comes to $6,000. You're still looking at double the return on your invested money buying the house, even putting 60 grand down. Okay. Third, it's true that there are some costs associated with owning a home. Less than 20% down, it does mean you're going to pay PMI or private mortgage insurance. There are also property taxes. There are maintenance costs. These are things that a lot of time, people underestimate when they buy their first home. A lot of times these are called unrecoverable costs because once you pay them, they're just gone. Okay. And they're legitimate costs, so it isn't wrong to include them in the rent versus own analysis, but it is wrong to include them for a homeowner while ignoring that a renter has equivalent unrecoverable costs. So for one thing, every rent payment itself is an unrecoverable cost. It goes out the door every month and it doesn't come back. And part of what you're paying for is your landlord's property tax, your landlord's maintenance costs, your landlord's mortgage interests. All right. For another thing, rent payments tend to go up over time, a fact that's almost never taken into account in these comparisons. A renter's payments go up steadily every year, and that can end up being a pretty big amount of money in a couple of years. Over that same time, if you're a homeowner, your principal and interest payments stay the same while your home goes up in value every year. So choosing to ignore renters' unrecoverable costs by making a big deal about it for homeowners, it's disingenuous at best. At worst, it's dishonest. I told you I was going to save an eye-popping number for the end of the video, and here it is. The Federal Reserve Survey of Consumer Finances found that in 2022, the median net worth of a homeowner in the United States was just under $400,000. The median net worth for renters, $10,400. And guess what? The National Association of Realtors says that inflation has taken those numbers to $430,000 versus $10,000 respectively for 2025. That's 40 to 1, maybe more than that now. Another study titled the 2026 Generational Wealth Report, conducted by the Realtor.com economics team, showed that buying a home by age 30 is correlated to a 22% higher net worth by age 50 compared to those who waited to buy until their 40s. That's an average of almost $120,000 of additional wealth just for buying 10 years earlier. Listen, at the end of the day, we live in an inflationary economy. Our government's committed to inflation. As far as they're concerned, the possibility of deflation is an economic Armageddon. They're just not going to let that happen. The system is designed to inflate prices and values. It's a feature. It's not a bug. So that's why that 40 to 1 wealth ratio happened. One group of people decided to take a relatively small amount of money and buy a much bigger asset with it, and it went up substantially in value. The other group didn't. That's really what it all comes down to. Listen, I'm not going to tell you you shouldn't invest in the stock market. It's an amazing wealth-creating machine in its own right. And the richest investors in the country don't have all their wealth tied up in houses. Of course, they're invested in the markets. And you probably should be too. But you can invest in the market and you can own a home at the same time. And I would argue that that is probably the most effective and responsible choice for most people to make. The financial commentary that tells you that home ownership isn't a smart use of your money, well, it's making an argument that is at best incomplete, and at worst, it's full of false assumptions for the majority of the people that it's trying to advise. At the end of the day, always remember this. You have to pay for housing either way. The only question is whether or not the money that you spend on it is going to go to work for you. Okay. Click the link in the description below, drop in your email. I'll send you a free copy of my book. You can do this, The No BS Guide to Financing Your First Home. Chapter 6 goes over all those loan programs with the lower down payment options we talked about a little bit earlier. If you find the information in these videos helpful, hit the like button and consider subscribing to the channel. So, What questions do you have about financing a home? Let me know in the comments and I'll be happy to respond. My name's Stan Brusoski, and I'll look forward to talking to you soon.